back here with another video. So on this session here today, we're going to be talking about the 8 charts of the growth stocks that are in bear markets. So growth stocks in bear markets right now as we speak. So you have been seeing that the market has been going down for some time now. So these are the 8 charts that I see that they have been adding onto the current bear market that has been happening. So before we move forward, guys, remember our risk disclaimer right there that trading CFDs or leverage products involves a high level of risk and loss. So a person is liable for either for a portion or an entire loss of their margin deposits. So please, guys, these videos are for educational purposes, not trading or investment advice. So it is important for you not to trade or invest money you cannot afford to lose. So guys, please subscribe, like and share our page here, Stocks for Hope, and also follow us on our socials there. On Twitter there it's Stocks for Hope, and then on Facebook there again is it's Stocks for Hope. So let us continue now. So what is a growth stock? A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the above the average growth for the market. These stocks generally do not pay dividends. Okay, this is the first point. This is because the issuers of growth stocks are usually companies that want to reinvest any earnings that occur in order to accelerate the growth in the short term. So they do not pay a dividend in order that they can accelerate their growth in a short space of time. So when investors invest in growth stocks, they anticipate that they will earn money through capital gain when they eventually sell their shares in the future. So I think this statement, it is straightforward. So let us move along. So growth stocks are those companies which are expected to grow in sales and earnings at a fast rate. Okay, we just mentioned that. So they are expected to grow in sales and earnings at a fast rate than the market average. So growth stocks often look expensive, but they often look expensive and trade at a higher PE ratio, but such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share price eventually up. So it has a higher PE ratio and a higher valuation, but it becomes a discount when the company trades growth rapidly and the share price is driven extremely high. So since investors are paying a high price for a growth stock based on expectation, if those expectations aren't realized, growth stocks can see a dramatic declines. So growth stocks typically don't pay dividends. Okay, growth stocks are often put in contracts with the value of the stock. So move along then. How do you invest in growth stocks? Why people invest in growth stocks? Investment in growth stocks can be risky, number one, because they typically do not offer dividends. And that point was mentioned. The only opportunity an investor has to earn money on their investment is when they eventually sell their shares of the company. If it does not do well, investor will take a loss on the stock when it's time to sell. So the company is not paying any dividend, right? So you are expecting that the share price will go high and then you will make money when the share price is going higher. But if the opposite happens, that the share price goes lower, you will eventually lose money when you sell your current holding. Okay, so which are the 8 growth stocks that I'm here to talk about that are not doing so very well, that are currently in a bear market? So number one, it is the ARK innovative ETF. So it is a very popular ETF there on Wall Street. Or it is the CEO of the ARK Innovative ETF is Cathy Wood. Cathy Wood is a well-known follower and supporter of Elon Musk. So ARK Innovative ETF, it is not doing very well. And then the next company is Shopify. Shopify, which is an online platform to do shopping there. In the United States mostly, but also around the world. So the next one that we're going to look at is ROKU. ROKU, it is a technology company focusing in gaming, but at this stage it is currently not doing very well. So the next one is Netflix. So why did I put Netflix here? Netflix, it is not paying any dividend, right? But it is part of the FAANG stocks now. Those FAANG stocks, that are those big technology companies that control the Nasdaq. But as well, it is part of these growth stocks now. So Netflix hasn't been performing very well in recent times. So the next one is PALANTIR. So PLTR, it is a technology company as well, but it has been seeing some major declines in its share price in recent history. And the next one is ROBLOX. So ROBLOX focuses in technology, and its main focus, it is there in the metaverse. So it was recently bought by Microsoft, but that story was only short-lived because the share price jumped for a couple of days, but it then eventually went lower. So after this, we're going to look at the charts as well. So another one is Meta Platforms, which is formerly known as Facebook. So Facebook has been there for about 17 years, if I'm not mistaken, from 2005 2006, and then it was listed there around 2011. So it has been there for some time, but in recent times it hasn't been doing very well in the market. So another one is AFFIRM there. So AFFIRM as well, it hasn't been performing very well there in the charts as well. So if we look at the technical part of these companies there, if you move away from because we've just said these are the ones that are not doing very well, so let us look at the technical parts of them there. So this is the ARK Innovative ETF. So if you move and zoom out to the weekly chart, we could actually see the decline there on the ETF. You could actually see the decline there on the ETF because it has been moving swiftly from March 16, 2020, which was the coronavirus low, but it moved higher to a high of $157 US. But from there, it has been just a downward spiral from there. And this previous week, it actually touched that low of the March 16, 2020 low. So we do not know what's going to happen with this ETF, but it is currently forming this wedge pattern. So maybe it has a fighting chance maybe to recover from this bearish action that has been happening. So the next one we need to look at Shopify. Shopify, as we explained, that it is an online shopping platform in the US, like eBay. So Shopify as well, from the March 16 low, it traded higher until it touched a high of 1,750 US dollars. But in recent times, it came back to that March to that March 16 low. So it's currently trading that on that March 16 low. So as well, it is forming a wedge pattern right there. Maybe as well this one has a fighting chance to try to recover its losses. Okay, let us check out Netflix. So the story of Netflix is a bit complex. Why I'm saying is a bit complex. Netflix is one of those huge multinational companies on that streaming services, né? But it hasn't been performing very well because like of user decline. User decline because people have been complaining about the content on Netflix, and also it has a competition right now like Disney also offering streaming services, and Apple as well also offering streaming services. So that has been a challenging part of Netflix now. So that's why they have been getting some user decline right there. So right now Netflix is currently trading below the 200 and let's say the $240 level. So what might actually happen here, maybe Netflix might come back to this level and then drop even further down because of the challenges that it has. So it needs to recover fundamentally before it can recover technically. So Netflix is a bit of in a tight space right there. So if we look at Palantir, so Palantir Technologies, so Palantir Technologies, so it was probably recently listed in September 2020, and it's skyrocketed, moving higher to $45 a share, but now it's currently trading below its IPO price. It's around about $7. So that's a huge decline. A decline below its IPO price that was staged. It's around about $9.50. So it's currently trading below. So also this one, it needs some serious fundamental recovery before it can actually recover on the technical side. Okay, so we did have a technical glitch right there. I'm sorry about that. So moving along, guys, let us look at ROKU. We did skip ROKU there, so let us check out ROKU. ROKU as well has been declining significantly. So this is a daily chart. Oh, sorry, this is a weekly chart. Almost March 16 low, went higher, did a double top there right there, and then came back down on the same low that it did on the March 16. So guys, there's something similar about these stocks now. There's something similar about them. I'll just explain in the end. So let us check out Facebook, which is Meta Platforms. So they changed the name, but they kept the ticker name so that people do not get confused when it comes to buying their share. So Facebook as well has been having some challenges with regulations in Europe, and also with taking down political political campaigns or something like that. So even Congress in the United States did take Mark Zuckerberg to testify rather there or in front of Congress to speak about what's actually happening there on Facebook when it comes to information gathering, or are they leaking people's information or data to third parties. So Facebook has been facing some of those challenges like that, and also sales they have been declining. But the recent earnings, they did show that something positive is currently happening there on Facebook. So it still needs a strong fundamental recovery here. Maybe it can bounce back to its all-time high of 387 US dollars. So the last one we're going to check out is AFFIRM. So AFFIRM Holdings, it too was recently listed in January 2021, and you can see the offering there was about $90, and the all-time high, the highest price it hit was $177, but from then it was a huge decline, and it's trading about 50%, about 70% rather below its IPO price, below its offering price. So the people who bought at the IPO price and didn't sell at the top are currently really feeling the pain right now. So for it technically to move higher, it has to do something like this. So this is the left shoulder, this is maybe the head, and then it needs to go higher and then comes back to form the right shoulder for it to complete a head and shoulder pattern, and then it can move higher. Okay guys, so there is something that is similar on these companies between Shopify, ROKU, PALANTIR, ROBLOX, and AFFIRM. You can see that they have the same pattern, which is almost a wedge pattern. Why do they have the same pattern? Because they are all part of this ETF, which is the ARK Innovative ETF. So most investors who bought the ARK Innovative ETF are also part of the investors that are buying the individual stocks. So if the ARK ETF is going down, also it drags those individual stocks along with it. I'm sure you guys understand, even when it comes to the NASDAQ, if those big companies, Facebook, Apple, and Google, Tesla, if they go down, they drag the NASDAQ 100 down with it. So here it's almost the same case now. When it comes to Shopify, ROKU, PALANTIR, ROBLOX, and AFFIRM, they are part of this ARK Innovative ETF. So when those stocks go down, they drag this ETF along with it. So guys, I hope you learned something on this video. Remember to like and subscribe, and please share as much as you can to your members, to your family members, to your colleagues, and also your friends who like or have also an interest in investing. So guys, thank you. I will definitely see you and check you out on the next video. So thank you and goodbye.